Welcome back. You're watching Traders Corner, and joining me as always is Garth Mackenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, it finally happened. The S&P opened actually yesterday at a new high and looks as if it's maybe broken through that psychological level we've been talking about for so long.
Yeah, that's it. So the level we're talking about is 2950, and if you look at the chart, you can see quite clearly where that dotted line is. That's that overhead resistance at 2950. It's been tested at the end of April and again now in the middle of June. And if I was to go back further on this chart, that's also where the September highs were last year as well. So effectively, it's tested that level 3 times, and now last night it finally managed to push out through that 2950 area. So it's gone on to make a new all-time high. Also note that it did create a gap up on the session, so that could be deemed quite bullish. Some might say that that is a breakaway gap. Some might say that it could be an exhaustion gap. So I don't know. I suppose we'll have to wait and see which type of a gap it is. But nevertheless, the fact that it's gone through that 2950 area is quite encouraging. And like I said, it takes the market to a new all-time high. We do just need to take into consideration the bigger picture, though. And this is a weekly chart now of the S&P 500 here. So it looks back over the last 2 years. And what's evident here is what I call a broadening pattern.
Or a megaphone formation.
Yes.
Or the jaws of death, as prices want to call it sometimes.
Well, yeah, you could call that a megaphone as well. That's also sometimes in technical terms, they'll refer to that as a megaphone structure. But what it basically is saying to you is that let's just be a little cautious. It has broken to new highs, but the area around 3,000, I do think that's going to be tagged. I've said a couple of weeks now that I think it's going to 3,000 and it's going to test that level. And it may very well push on a bit beyond 3,000. But just be aware that the top of that megaphone or that broadening structure comes in at around about 3,000 or just above. It could quite feasibly go a little bit above there. But just note that in the past, each time this market's made a slight new high, it has been very short-lived and then it's pulled back. So
pulled back sharply at that.
And pulled back sharply. So I'd just be a little bit cautious on getting overly excited about the market breaking to new highs, and particularly this time of the year, because remember, the middle months of the year we have often found are actually quite choppy. And so for that reason, I'd be wary of chasing it higher.
Yeah. And it's also trading way above its 200-day moving average, which suggests that it's kind of dislocated itself from some fundamentals.
Well, yeah, that's it. So, I mean, look, over time you would get a reversion back towards a 200-day moving average at some stage. On this chart, because this is a weekly chart, that blue line that we're looking at, there's actually a 50-week moving average. But actually, I mean, really, 50-week moving average and a 200-day moving average usually are not actually that different to one another in terms of where they're situated. The point I think that you're making, and rightly so, is that it has moved quite a far way beyond that, and at some stage some sort of mean reversion is possible.
Yeah. Then what about the top 40? We are kind of inching forward, and not really, after the break that we made, we kind of seem to be going sideways now.
For now we are, yes. So the range that we're kind of in at the moment is between 52,000 and up to 53,200. You can see that quite clearly over there. 53,200 is the prior top that we saw in April, and then it's been retested again now in the middle of June. And now it seems as if this market is range bound for the time being. These long tails to the upside on the daily candlesticks there indicate that there is some selling evidence at the upper levels. If that persists, then there's a risk that we maybe break down below 52,000, in which case then we'll probably head down to the 50-day moving average there, which is at about 51,300 and possibly even a little bit lower. It's a possibility that we could be seeing the early stages of the right shoulder of a head and shoulders begin to form over there now. But I don't know. I mean, it's difficult to make that kind of a prediction beforehand. What I will say is that for the time being, it does seem pretty much range bound and it's going sideways. And that's not entirely uncommon at this time of the year to see the market drifting sideways.
Yeah. So it's not surprising that you had looked offshore for trades and trading opportunities. Last week, you went long of Amazon, and that does seem to be working out quite nicely.
It is working for us. So here's the chart of Amazon. We flagged it on each of the last 2 shows, and again this week we talk about it here. So what I had identified 2 weeks back was the fact that the price looked to be breaking to the upper end of this little small pennant pattern, or it's like a small triangular pattern. That is typically a bullish continuation pattern within a rising trend. Also, the fact that it was above the 50-day moving average there was encouraging. That I always like to look at the 50-day moving average as a medium-term indicator of the the momentum. If your price action is above the 50-day moving average, generally the bulls have the upper hand. If your price is below the 50-day moving average, then the sellers have the upper hand. That's a very, very basic rule of thumb. But in this case, it seems to be working, and my slightly bullish bias does appear to be correct for now. We went long of 7 CFDs on Amazon last week at $1,889, and we're looking for a move basically back to the prior high that we saw in the beginning of May there, which comes in at 1,960. Now, if we look at the chart pattern and just refresh it in terms of apply some new analysis to this chart now, what it seems to me is that we've got a bull flag pattern there that is now also broken to the upside. And that is a bullish development. And from a technical measurement perspective, that also gives us a target up to 1,960. So for the moment, it's looking good for us. We are on the right side of this trade. The stock does still seem to have upward momentum in its favor. So we sit tight and we're still long and making a bit of money here.
Yeah. Garth, and then last week, we did discuss the gold price last week because we were looking at the fact that it had punched through $1,400.
Yeah.
And it's come back a little bit. So now, you feel like a bit of an idiot because you start talking about the gold price and you think, okay, well, it's clearly too late and it's all over. But is it? Or do you think actually maybe this is a bit of a consolidation in a longer term upward trend?
Yeah, so I don't think it's too late. I mean, I think if anything, maybe it's only just beginning to get going in terms of the possibilities here. That break that we saw above 1,350 in late June was a very, very bullish break. If you have a look there, notice this is now six years of trading action that we're looking at here. And you can see how the gold price has bumped up against that resistance line numerous times over the last 6 years. The break through 1,350 there is now the bullish break that actually now takes it out through all of that resistance. So strictly speaking, from a technical perspective, when you've got such an enormously long base like that, it should actually give you a fairly big upside projection. Okay. What always does happen with a breakout like this, though, is you usually get a bit of a retest. So last week I said it was looking a little bit stretched, a little bit overbought, and the likelihood was that we would see some consolidation, perhaps a pullback towards the breakout area, and that would then set up the next opportunity to buy gold. And the thing is, this time you'd be buying it knowing that the breakout has happened. You're not hoping for a breakout, which hasn't happened for 6 years until now. So that's the long-term chart. Now, the next chart that I'm going to look at really just zooms in on effectively the trading action since the beginning of this year. And there you can see it obviously more zoomed in, but there's the breakout through 1,350 that we were speaking about on that long-term chart. You can see how the price punched out through there, and it went very quickly from 1,350. It got all the way up to 1,440 within a matter of days. Yeah. So quite a powerful breakout. And as I said, what's likely to happen is you're now likely to get some what we call backing and filling, where you get essentially a bit of a consolidation and perhaps a retest back towards the breakout area.
Sort of like how you might mine a gold mine.
Yeah, I suppose you could say so. So what you'd look for now really is a pullback towards that breakout area, around about 1,350. I would then think that there's a lot of solid support around there, and that would probably be the area where you would want to look to accumulate gold if you've got a medium-term view. So I'm not rushing out and buying it now, but I think it's worth paying attention to, and it's very likely, I think, that in the weeks ahead, if we see a pullback towards that area, that's where you would look to enter a medium-term long position in gold.
Yeah. Okay, Garth, so gold is yet again something to watch. It's, I suppose, been the ultimate alternative currency for the world for hundreds of years. The cryptocurrency, Bitcoin, is something that we're going to be discussing now. I don't think you and I have ever chatted about Bitcoin on this show. I didn't think you were a Bitcoin believer, but why have you got a chart of the cryptocurrency up tonight?
Yeah, I'm a skeptic, but I must say, as I learn more and more about it, I think my skepticism is softening. But yes, a disclaimer, I've never traded Bitcoin in my life, not to this point. But I do watch it with a lot of interest. It is incredibly volatile, and it's an interesting product to trade. I mean, perhaps at some stage I will dip my toe in here, but I think one does need to take into account it comes with a huge health warning because it is very, very volatile. The movements are huge, and that's what we've seen over the last 2 weeks. And that's what I want to focus on this week, is looking at the hourly chart of Bitcoin. And this is an hourly chart that really goes back over about the last 2 or 3 weeks. So not a lot of trading history. But in that time, you can see Bitcoin's gone from around about $7,000 per coin. It rallied all the way up recently to nearly $14,000 So it doubled in that space of time. And not long ago, it was down below $4,000 per coin. So it's had a huge move up in the last couple of weeks. But why I want to flag it is really just because it is interesting to look at it in terms of the trading dynamics and how it follows the same behavior as most financial markets would, but it just seems that the movements on Bitcoin are much, much quicker. So let's have a look this week. What I want to flag here is the fact that you've got this rising trend, and it gradually becomes more and more euphoric.
Yeah.
And that's what you can see with the steepening of those rising trend lines there. And eventually you get this what's termed a blow-off move, where effectively the chart starts to go vertical. If it was going to go any steeper, it would probably want to fall over backwards, right? Now, once you get to that stage, that is unsustainable. And usually you do get a crash that follows that, and that's exactly what we saw. And this is now, by the way, only Thursday last week.
Yeah, I mean, this is all playing out in the space of a couple of days.
Wasn't long ago. Right?
It's not 1929, folks.
No. This was just the other day. It was literally Thursday and Friday last week. The price got to $13,800. It dropped all the way down to $10,400. And I mean, that's like a 25% crash. And it is a crash. I mean, when you see something collapse in that quickly, that is a crash. And then what I want to specifically focus on here is the trading action that's followed, because I think we have flagged this on the show in the past, but every type of market crash that is, anything that becomes exuberant and then eventually crashes, tends to crash in exactly the same way that what we've seen here. So initially, you get that huge leg to the downside,
Yep.
right, which I've labeled A in this case. Then you get a B leg, and that is a rally, but it's unable to go and take out the prior top. And then you start, it falters, and then you start to get another move to the downside, and that's your C leg. And it's just interesting to watch. I mean, now we're sitting with Bitcoin down below $10,000 at the moment. So it's fallen effectively 30% since Thursday last week. But the reason I bring it up is purely because it's just interesting to see the trading dynamic and note how it follows the same patterns as all other financial markets typically do. It just seems to make its movements much, much faster.
Yeah, and I'm sure there's reasons behind that, but we've run out of time. So very quickly, let's wrap up the portfolios and just remind people of your course on the 3rd of August.
All right, so the SA portfolio is the same. We haven't done anything there over the last week. Offshore, we're making some money on that Amazon trade, so we're close to the flat line now for the year to date, so looking slightly better there. And then the course you mentioned, I'm running a high probability trading course on the 3rd of August in Johannesburg. If anyone would like to attend that, please send me an email, garth@traderscorner.co.za, and then I'll send you all the information.
Great, Garth, we'll leave it there. Thanks as always for joining us. Garth is founder and editor of Traders Corner.